Boom. What's up, everybody? Thanks for joining us for today on the Build and Grow with Real Estate Show. Our guest today is Kate Del Rio from Honest Home Solutions. And today we're going to be talking about the market and forecasting what we're looking at in 2023. I got some odd audio stuff going on, so I'm going to be fooling with my earbud all day so that I can hear what Kate's saying and not have to listen to an echo of myself. Kate, for those joining us for the first time who've never met you or have never bumped into you showing houses or whatever, tell us a little bit about you, and then also about Honest Home Solutions, and let's take it from there.
Sure, great. Hi everyone, I'm Kate Del Rio. I work at Honest Home Solutions. We are a real estate investment company, so we do genre things with real estate. We will hold some, we do a lot of renovations, but I would say maybe 70% of what we do is wholesaling. So we buy about 10 to 15 properties a month. So I'm always looking for new investors to add to my buyers list. So my position is dispositions. So I have Nico, my acquisitions agent, and he goes out and meets with the sellers and gets the houses under contract. Then I reach out to my buyers and see if any investors are interested in the property.
So if you're new to real estate, you've never had any experiences with a wholesaler before, Kate, tell us why somebody would work with a wholesaler. Like, why not call up your local agent? Why not, go knock on doors?
So with us, you don't have to pay any commissions. You don't have to do any inspections. It's really just as is properties. We try to purchase properties fairly, but relatively cheaper than most people are able to acquire them. And then we have investors that really trust us, that they know we're going to bring them good properties. They know we know what we're looking for because we're also real estate investors. Sure.
That's great. I introduced Kate, but I didn't introduce myself. My name is Josh Weidman, if this is your first time watching it. Awesome. I'm a private home money lender right here in central Pennsylvania. We fund fix and flips, fix and rents, small commercial or small cap commercial, 1 to 10 million. Residential from 50,000 on up. And our claim to fame has been, we can underwrite your loan on the day that you call us, get you approved, and we can fund within 24 hours if your title work's ready and your ducks are in a row. So if you're looking for funding, whether it's because some things that we're going to talk about today with some changes in different lending, and I got Kate here on the hot seat because I didn't even give her any questions today, but we're going to talk about like some changes that we've seen directly in the market, what some people are, industry insiders and other industry professionals are talking about, and see how that's going to correlate to 2023. But, if you are looking for a hard money loan, you can reach out to us at hardmoneybankers.com or give me a call at 717-213-8488. Now, Kate, let's get into this. Earlier this year, we got 20 people lined up at an open house, to come out and make offers. And this is on listed properties. You got, 15, 20 offers on every property, bidding way over asking price. And in 12 months, things changed quite a bit, right?
Yeah.
Now, I can imagine that as a wholesaler, that presents a whole new set of issues that, 12 months ago, the issue was finding properties, I can imagine.
Yes. And now the problem is, not like a huge problem, but now what I'm noticing is my investors that were spending money last year with not even blinking, not even flinching, they were ready to overpay for these properties that I was sending them. They're very guarded. They're very hesitant. If
Sure.
It's going to take them 3 to 4 months to do a renovation, they're worried about what the interest rates are going to look like. End of that.
It's been a really interesting dynamic because as the prices, they haven't really even come down. At this point, we're still looking at price points that are very similar to what they were a year ago, in some cases even higher, with less competition and drastically higher interest rates. What have you noticed? It's easier to find discounted properties, or what's your volume? What has your volume looked like over the last year on a monthly basis? You said 15 units a month. Has that been consistent, or do you see spikes during the summertime? a lot of or spring and fall, like a lot of realtors do, or what? Tell me a little bit about what changes you've seen, and over the last year.
Sure. Yeah. So I mean, we did see a spike in the summer. I would say now we're a little low in inventory, but we feel confident, that it's going to work out. I think the biggest thing for us is just noticing our buyers pool. The investors are very worried about their exit strategy.
Sure.
In 3 months.
Well, so this is something that really hits home for us because we're a hard money lender. We're a lender in general, and so hard money is generally a little bit more expensive, sometimes a lot more expensive than what you're seeing in a retail market. But it's got some positive factors to it. Over the last, I don't know, 5 years, strike that 5 years. Let's say 2 years. We've seen a huge change in having these nationwide hard money lenders that, were very comparable to what you might have seen for conventional mortgage 15 years ago, 6-7%, 1 point or no points on the origination, very aggressive leverage. And over the last certainly year, that's changed quite a bit. I mean, we've seen a lot of national hard money lenders just going out of business. We've also seen, I was surprised that beginning over the summer, a lot of the local lenders started referring me business because they ran out of money. And so, I think it's an interesting dynamic that, you've got factors like, hey, it's hard to get out of a loan that I got 6 months ago, because now the value's changed, the cash flow's changed. Now my interest rate has gone from, potential 4% to 7% or 6%. You know what I mean? And it changes the investment.
Right.
Yeah. And so I think it's kind of, we get a little bit of an inside eye on what is going to be happening over the next several months, simply because, we have people calling us. We have people calling us for deals or not, or calling us for loans or not. And I think a year ago when really the negotiation was, how can I get this property under contract? What do I have to do to get it under contract? Now it's, how does this deal work for me? And at what price, at what rates, at what terms? And like you're saying, like having a couple different options for exit strategies is a really important thing to do, over certainly the next year, 18 months for sure.
Right. Because I am noticing that people are just very, they're being very conservative because if they don't have that extra cushion, 4 months, and then what if the house, they say they renovate the house, they dump all this money into it, they owe hard money loans and, et cetera. And, then the house doesn't sell and they're up a creek because their buyer's pool has changed drastically.
Well, right. And really, at the end of the day, if you can't, you're buying an investment property for one reason, and that's to make money, right? If the price is, if your exit was 200,000 on this property and now it's 150, and you didn't buy it with that anticipation, it's really hard to, it's really hard to get out of. Likewise, I think that we're also in a time where we haven't really seen the comps change. There's maybe there's more houses on the market, but you still have strong sales. So the nice thing is that you're still able to get out of these deals if you have to. It might not be the number one option, but doing a refinance and holding on to this property for a couple of years as a rental is not a bad backup plan. You just have to make sure that you know what your options are going into the deal.
And it's interesting that you mentioned holding it as a rental, because I'm hearing that a lot more too, that we're going into a season that it's going to be rental properties are going to be in high demand. People are going to be foreclosing on their houses, and so then there are places to rent. So it is a good time to get into the buy and holds for sure.
Well, it's interesting though. As you say that, I've been looking at forecasts for months, trying to get a beat on what happens next. Where do we go from here? And I think we end up with two different options. Either the Fed backs off of these interest rate hikes, and if that happens, we end up in a scenario where rates go back down, housing gets more competitive. But I think ultimately we're still battling inflation there. And, any increases in property value are really just sticking with inflation. And then the other option is the rates keep going up, and that's not such a great one too. That's a pretty bad outcome too. Nobody wants a 15% interest rate on a primary residence.
Right. Exactly.
Yeah. So, you think about what were you doing in 2008, 9, and 10?
So funny. I was just going to bring that up. I actually wasn't even in the real estate world.
Right. Yeah. And I think most people in the game right now are in that same spot, right? But in 2009, 2010, we were wondering about the same thing, right? The question was, where can I get the money, right? What's the interest rate I'm going to have to pay? And who's going to buy this thing when I'm done renovating it? And so it's a very interesting time to look at this, because we're pre-crash. We had this huge spike over the last year. I mean, that's like the largest and fastest increase that we've had in housing prices in a long time.
Right.
So it's inevitable the prices are going to come down, but the environment's such that, like, if the Fed backs off of these rate hikes, we could just keep creeping higher and higher and higher. And the question is just how long, and I think that's really the forecast in 2023. I've seen everything from a 1.5%, projections of 1.5% decline in property values to as much as 20% over the next 12 months. And I mean, that's a big difference. But I think that, that big range is due to the fact that people just don't know. They don't know what the financing is going to be. They don't know what the demand is going to be. They don't know how easy, the liquidity is going to be. What we also can learn from that time, though, is that the people that bought in 2009 and 2010, they are really happy. Like, they did really well.
Right.
Yeah.
So, I mean, now I have a question. I think it's going to be as bad as 2008. I mean, no one can predict it, right? But in everything you're reading, because I keep hearing over and over that nobody thinks it's going to be as bad as 2008.
I think the rates either keep going up, and if they keep going up, I don't see there being a market for housing, right? Like, if people always have to move, they do, right? At some point, there's a cap on what someone can pay for a house. Right. And, and the increase in financing costs and the increase of the cost to own the property is going to necessarily drive down the price of housing. That's if interest rates stay high. If they go down, I think it could be even worse, because I could see a situation where, the dollar gets separated from, is no longer the world's, primary currency or the default currency and trading currency. And that changes the whole dynamic. And now we're talking about, a lot more pain and suffering. So I don't know. I'm a doom and gloomer with housing. I am. I've been waiting for the crash since 2009. So I don't know. Do you take what I say with a grain of salt? But I see in the market right now, I think that the people, you have two groups of people that are buying. You have people that are buying who are experienced, have been through this before, and they know that there are discounts coming. So they're buying at a discount on cash flow, even on a flip. And then on the other side, you have newer investors that are trying to hold on to the good days that we've had and are over projecting their after repair values, using comps from June when we had 4% interest rates, right? Yeah. Now it's only 5.5, 6 now, but it could very easily be 8 or 9 by the end of the first quarter next year. And that's a really hard thing to explain to people. It's like, it's not that long ago. Nothing drastically has changed in the market, except that people are paying twice as much for their money.
Right.
And
we literally have an office meeting about this.
Right. And like, having that conversation with the seller is super hard. I mean, trying to make them understand that if they would have sold, a year ago, they'd get $50,000 or $100,000 more for their house, that you'd think they're crazy.
Right.
But like, people won't get pre-qualified for loans based on how much they can afford on a dollar amount. It's the monthly payment. And so with that monthly payment, if that monthly payment doubles or triples, now they're shrinking the size of their loan, which is going to put them in a whole different category of house. It's like you go from looking at a 5-bedroom house to now I'm looking at a townhouse with 3 bedrooms, and like it's the same monthly payment. Like I don't even want to move. Forget it.
Right.
Right.
Yeah.
So I don't know. What have you seen? What have you guys been seeing as far as volume? Are you doing as many projects, in November than you did in January of last year?
Trying to even think about January of last year. I mean, currently I have 6 renovations going on right now, but we're really, trying to wrap them up as quickly as possible. I am noticing my investors are doing more like lipstick jobs, which is, just kind of going in, throwing carpet and paint in there, updating the kitchen a little bit, but not like putting in a whole lot of granite countertops and like wow factors, because they don't want to put the money in. They don't want to spend so much money on renovations. They want to kind of get in and out of the project.
100%. Well, and it's that variable of what's going to happen over the next year. I mean, I feel like every time you turn on the TV, every week there's some bombshell that that changes something. And at this point, like, can you project out 3 months with a good amount of certainty? Yeah, probably can. Can you do 6 months? I don't know. 9 months? Like now it gets awful foggy really quick. Yeah, so it makes a lot of sense to do the smaller rehab, put less money into it, and get less money on the resale, but at least you're getting the thing done.
Right, exactly. You didn't lose money. Yeah.
What do you think are some of these changes that we should expect to see from investors in 2023 that, as opposed to what they're doing now? I mean, you mentioned, maybe smaller rehabs, but is there anything else that you think your investors are going to be moving into?
Well, I think we're all holding our breath to see if depending on how it changes, we're really going to be able to pick up properties very cheaply.
Yes.
That's, so I think some of my investors are sitting back and kind of waiting for that to see if that happens. Not maybe purchasing as much right now, kind of just seeing, So,
well,
I mean,
that was something that I thought was really interesting is how the number of cash buyers in the market, they just kind of disappeared. You had all of these people coming out of either downsizing during this boom or upsizing, where they're coming into a property making a really nice profit on the sale of their last house, buying their new place, and I think in 2021, something like that, in the summer of 2021, I think something like 40% of houses were purchased in cash. And now that's a huge amount. That's a huge amount of the market. So moving that now to a year and a half later, in December 2022, the numbers have dwindled significantly. And I think that cash buyers are kind of sitting on the sideline, not completely, but
because their cash close.
Say that again.
Well, they want to keep their cash close too. Like they don't want to.
Right. Well, yeah, they want to keep their cash.
Right.
Exactly. And then knowing or hoping, I guess, that the prices will be lower in the future.
Right. And then I'll be selling one.
That's right. There you go. So, all right. I'm not going to sit here and grill you all afternoon, but is there any insight you want to leave with our viewers as far as like going into 2023? What would your recommendation be as far as looking for what type of properties, what options and opportunities you foresee into the coming year?
Yeah, I don't know. I just think I don't think we need to be scared. We just all need to be wise and smart and watch the market and watch what's going on. Real estate's always going to be a good investment, right? So I think we need to be wise. I know some of my investors that were only into moving into buy and holds. I think you just have to shift with the market, be wise and just watch it.
I think that's good advice. I'm going to add to that.
Sure. Go ahead.
this is kind of a cheat. More and more as I've been pulling comps for loans on different properties, I'm not just looking back at the last 6 months or year or whatever. I'm going to look back at some pre-COVID numbers because we had this COVID bump in values that was pretty significant. I think that going into 2020, and I was pretty darn certain that there was going to be a downturn, and I thought that the cycle had come to its end, and then all of a sudden COVID shows up and we got an infusion of capital all over the world and everything shuts down, right, and housing prices go crazy, so it's at least a good indicator of where things might go back to. Maybe not in the next year, but if you're looking long term and we deflate the currency a little bit and strengthen the currency a little bit and kind of bring it back to maybe where it was, I think that's gonna have a big impact and at least can give you some insight on where we go. The other one is years ago. I mean, I was wholesaling in 2008, 2009, and I can remember going to look at this house in Point Breeze in Philadelphia, and it was on Reed Street. If anybody watching cares, but the bottom line is, this was an area that had just started going through gentrification in like 2007, 2008, and then the crash happened. So you had these completely renovated row homes that were selling for $135,000 and people were buying them. But then the people that moved in, they didn't like it anymore. Like, there was no more gentrification. The movement had kind of stopped. And so they were stuck in these houses that were half done and the neighborhood wasn't improving. And they just wanted to walk away. And I can remember going on an appointment and this girl had just bought the house. She had a $125,000 mortgage. She wanted to hand the house over to me. And, I said, no, I'm not, I didn't know enough to say, hey, yeah, that sounds great. But right, fast forward a couple years into recovery, the first area that just exploded in Philly when things started recovering, Point Breeze. And so that $125,000 house is probably worth about $400,000 to $600,000 right now. And we're talking about, 10 years, 12 years, whatever it is, 13 years, 15 maybe. But still, you're talking about tripling in value in that short period of time. And if you look back, that happens and especially in cities all the time. You start development, it stops, and then it recovers and it goes on. Mm-hmm. So, yeah.
Well, that's good. That's encouraging.
There we go. Anyway, all right. So that's it for today. We're gonna call it quits. Kate, how does somebody get in touch with you if they want a banging deal that they can't say no to?
So you can find me at honesthome.com, honesthomesolutions.com. Yeah. Call me 717-829-5453. We do buy all over central Pennsylvania and some of parts of Maryland. So don't hesitate to reach out. Let me know what you're looking for, and I'll get in touch with you.
I love it. I love it. Kate, thank you so much for joining me today. And, we didn't even talk about the event tonight.
Oh, my gosh.
Oh, what's wrong with this? Okay. REI Unplugged tonight.
Yes, I'm having REI Unplugged meetup tonight at the Penn Harris Hotel in Camp Hill, 7 to 9. So I'll see you guys there. It's going to be a roundtable discussion.
Awesome.
All right.
All right, guys. Thanks so much. We'll be back here again soon. Till then, you guys have a great day. Have a good lunchtime, and we'll catch you again soon. Take care.
Awesome. Yeah.